the most obvious advantage is that when we find something that we think has material upside, then we want to maximise the reward we get from that upside. So we like to have a big position, and we can have up to 10% of our fund in one position. I think a benefit of concentration that people don't appreciate as much, but I think it's equally important, is I think it really acts as a very good risk mitigant, because we only buy those businesses that belong in a concentrated portfolio. So we buy businesses with very good underlying economics. We buy businesses with very good competitive positions and enduring competitive strengths that we think will last over the long term. And by doing that, we I think, take a lot of risk out of our portfolio. And a lot of people who have more diversified portfolios really don't know what they own. And I don't see how that can be a low-risk investing approach, to own a lot of things but know very little about them. We prefer to own a few very high-quality businesses and know a lot about them. And that's I think the recipe for attractive returns over time. We also do other things to reduce risk in a concentrated portfolio. So we don't use leverage in the portfolio, which I think helps to reduce risk materially. And most businesses that we buy have very good capital structures. So they're high-quality businesses with good underlying growth. They're also well capitalised, which gives lots of downside protection and optionality for upside as well. The starting point for our investment process is always looking for a high-quality business. And one company we own at the moment is a company called Clear Media. It's one of the leading outdoor advertising companies in the Chinese market. It controls the outdoor bus shelter advertising. Over the years, it's become more and more dominant in that market. It now has 90% market share in the main Chinese market, so Beijing, Shanghai, Shenzhen, Guangzhou, 90% plus market shares. It has 60% plus market shares in most of the tier 2 cities. So it's essentially a monopoly. And we like businesses with limited competition because there's all sorts of benefits that come from that, including pricing power. For 15 years, they've grown earnings at 10 to 15% a year, a nice steady earnings growth. Their returns on invested capital have grown from 10% to well over 20% now, and every year their margins get better, they grow strongly, and their return on capital grows. They're well capitalised. About 20% of the current value of the company, the market capitalisation of the company, is in net cash on the balance sheet, so a very robust financial structure. They've returned about 30% of their current market capitalisation in special dividends over the last 5 years, so they're generating lots of cash, returning that cash to shareholders. So we just see a business in a very dominant position, huge barriers to entry that no one, even the largest companies in the world who have tried, can't breach. High returns on capital, run for shareholders, getting stronger every year. So when we found that company, it was very unknown, and we were able to buy that at about 4 times EBITDA, which is a very cheap price for this type of business, which is often trading at 10 times EBITDA or plus for peers. We've made good money on it over the last 3 or so years we've owned it. It's continued to grow. It's still trading at about 5 times EBITDA, so still very cheap. And we think at some point, even though we've been rewarded to date, we'll be very well rewarded when the parent company decides to sell, and we think that will happen at some point. And until then, we're happy growing a business that just gets stronger every year.